Right, good morning everyone on Thursday the 27th of July as we head into European trade for the day after a pretty uneventful FOMC decision last night. They did raise rates, obviously markets were expecting that, we were all expecting that as what they had communicated to markets and what markets are priced in. So again, as we alluded to yesterday, absolutely no surprise whatsoever, 25 basis point hike. That is not what we were looking at. We were looking at what they are going to do going forward. And they did not reiterate the stance of 50 basis points, double 25 basis point hikes. They pushed back on that and went back to the data dependency route. They were data dependent going forward, but they did the last dot plot did suggest 25 and 25. Now they did allude to 25 and 25 being appropriate still going forward, but now it is just complete data dependent, and they sort of a little bit poured cold water on the 50 basis point situation. So markets sort of feel as if the rate hike cycle is seen ending, and really there's not a lot for us to do or take out of that event until we get a couple of inflation prints before the next FOMC decision. So two inflation prints, really a non-event. Policy is restrictive but hasn't been restrictive for long enough. The data doesn't really suggest a recession yet, so until we get some inflation prints that come in higher than anticipated, we are not likely to see another rate hike as of yet. But they have raised rates substantially so far, and because of the lag on policy effects, or the lag on policy decisions in terms of the effect on the economy, they will not want to raise interest rates too much further until they start to see that fully take effect on the economy. So these two inflation prints before the next meeting will probably decide what we get at September. So until then, seemingly a green light for risk assets to continue pushing higher, and there's nothing really to stop it, as the US not seen entering a recession, or not a high chance of the US entering a recession. Really, I think we'll need to see some sort of unemployment rise in order for the Fed to really start thinking that way. But those inflation prints, you got two inflation prints from now until the next meeting. That is what we need to keep an eye on, and the incoming data to support that. Apart from that, nothing really out overnight. Read these sort of articles. Investors dumping China, load up on other emerging markets, but I personally don't look at the emerging markets too much. I'm more worried about the kind of G8 stuff and what goes on in those sorts of countries, and obviously the Chinese get included in that. But in terms of what that means for markets, I wouldn't suggest too much. But yeah, we are we're a bit struggling for other direction apart from that whole lot of nothing from the Fed last night. So I look forward to the ECB today, see what they have to do for themselves. We'll cover that in a little bit later on of a video. We'll dedicate a video specifically to that in a couple of hours or so do stay tuned for that. But apart from that, see what's up and what's down. You can see stock indexes pretty green across the board. You can see US equity futures, European equity futures green across the board. Asia Pacific equity futures higher across the board, apart from one outlier at the moment. Oil up slightly. Commodities pretty mixed though. You can see bond yields pretty mixed, some down, some up, some down, some up. So not really a great deal of information we can look to take off of the bond markets, and as we head into European trade for the day. US dollar lower across the board, really not by that much. Is against the Australian dollar and the Kiwi dollar, as they are the two strongest currencies in the overnight session, going in line with those equity futures pushing higher. Aussie and Kiwi push higher. Then with that, Canadian dollar, euro, sterling, yen, Swiss franc, all pretty mixed. So a lack of clear direction across a number of the major asset classes. As I said, stock index is higher overnight off the back of that Fed decision. As I said, it seems to be a green light for risk assets to continue pushing higher, unless those inflation prints decide to come in higher than anticipated. Economic calendar, you can see obviously Thursday got the ECB, as I said. We will update on that a little bit later on. 115 interest rate decision. Apart from that, nothing out really overnight. Some consumer confidence figures which are bad, but in line with consensus bad, so nothing too much to see there. There's a bit of negativity surrounding the Eurozone again. We've had a raft of weak economic data out of Germany. We've had terrible manufacturing PMIs, bad business climate figures, consumer confidence figures again bad. Does that feed into the ECB's thinking? They are obviously a full 1.5% lower in terms of their interest rate at the moment. That will obviously decrease to 1.25 once we get The 25 basis point hike at 115, the supporting commentary around that is what we need to look for in terms of future price direction across European assets. But as I said, we'll cover that a little bit later on. You can see the Aussie and the Kiwi popping higher in line with those stock indexes higher. You can see Euro grinding higher, cable grinding higher, dollar Swiss, dollar yen, dollar CAD grinding lower. So clear US dollar weakness across the board. Not aggressive US dollar weakness, but it is still clear direction across the US dollar. A lot of these pairs are trending with higher highs and higher lows, or lower highs and lower lows. So as the side of defense, I think you need to sit on. Dollar yen, dollar Swiss, selling rallies probably seems appropriate on that. Buying dips on cable for now seems appropriate, as the monetary policy divergence within certainly the UK and the US is likely to continue going forward. You can see this yields is something definitely to keep an eye on. That dollar Swiss, that dollar yen, certainly something to keep an eye on if these yields continue to push lower. Now, if the 10-year and the 2-year continue to push lower, that is likely to prove negative for the US dollar, probably supportive for stocks. But if you're trading US dollar, dollar Swiss and dollar yen are the best currencies to trade if you are using the correlation of these yields. You can see oil pretty mixed, pretty sideways. We're waiting for future for another kind of fresh drivers in terms of the price of oil. Obviously been up substantially off the back of supply constraints, removing of supply from production of oil on a daily basis. Rally has stalled slightly, but the fact that it's stalled, probably look for it to continue higher at some point if it wants to kick back into gear. Gold grinding higher, just in line with that US dollar grind lower. That's really where we are at in terms of today's trading session. So keep an eye on those yields. 10s and 2s likely to give us some direction going forward. They push lower, should be US dollar negative, stock index positive, and probably gold positive as well. Obviously vice versa that as we head on into the rest of this week's trade. ECB at 115, likely to shake up markets a bit, or maybe cause a bit of sideways price action into that. Till we get that out of the way, maybe be a little bit careful about going and piling into positions. But certainly a bit of a negative reaction to the Fed last night. Stocks like it, dollar doesn't like it, and if that's the main reaction so far, it's probably the side of the fence I'll choose to sit on in the trading sessions ahead.